Picture this. You put money into a fund. 2 months later, it has nearly doubled. That actually happened this year. The fund is called DRAM. It's the Roundhill Memory ETF. It launched on April 2nd at around $28 a share. By late May, it traded near 63. That's close to a 100% gain in under 2 months. And the money came rushing in. This DRAM ETF crossed $10 billion in assets faster than any ETF in history, faster than any Bitcoin fund, faster than anything. So let me say the obvious thing first. That is impressive. I won't pretend it isn't. But here's my honest answer to the big question. Should you buy DRAM right now? I'm not chasing it, and I want to show you exactly why. By the end, you'll understand 3 things: what this fund actually owns, why the smart move here might be to wait, and the one risk the people rushing in are not looking at. That last one matters most, because it's not about whether the story is good. The story is great. It's about something else entirely. Quick note before we go further. I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Okay, let's slow down and look at this together. Why everyone's right about the hype? Here's the part I want to be fair about. The excitement around this Roundhill Memory ETF is not fake. There's a real story underneath it. For 2 years, everyone talked about AI chips, the big computer brains that run things like ChatGPT. Those chips got all the attention. But a chip can't think on its own. It needs memory, a place to hold all the information while it works. And the newest AI needs a special kind of memory. Think of it as a tiny stack of chips, built like a little skyscraper, sitting right next to the brain. It feeds data in fast, very fast. Without it, the expensive AI chip just sits there, hungry, waiting. So this memory became the new bottleneck, the thing everybody suddenly needs and can't get enough of. Now here's what makes it interesting. Almost nobody makes this memory, just 3 companies, SK Hynix, Micron, and Samsung.
That's it. 3 companies feed the entire AI build-out, and right now, they've sold out their supply for the whole year. When everyone needs something and only 3 make it, the price goes up, way up. Memory prices roughly doubled in a single stretch, the fastest jump on record. One of those companies, Micron, saw its stock rise about 700% in a year. 700! It even crossed a $1 trillion value. So I get it. People look at all this and think, I want in. And the DRAM ETF is the easy door. It holds these exact companies in one package. So if the story is this strong, why am I still sitting on my hands? Here's where it gets interesting. The myth that costs people the most. Let me show you the thinking trap, the one that quietly costs people the most money. Here's the myth. When a fund doubles fast and billions pour in, that's a buy signal. It means you should jump in too. It feels right, doesn't it? Everyone's piling in. The chart points straight up. Surely that's proof. Here's the truth. That feeling is often the warning sign, not the green light. I'm not just saying that. There's real research on this. A major study looked at over 500 of these narrow, theme-based funds, the kind built around one hot story. What did it find? On average, these funds lost about 30% in value, adjusted for risk, over their first 5 years. Read that again. The first 5 years, the exact period right after they launch with all the hype. Why? Because these funds tend to launch when the story is hottest, and when the story is hottest, the prices are already stretched. You're buying at the top of the excitement. We've seen this movie before. Remember the big innovation fund everyone loved back in 2021? It peaked, fell more than 50%, and years later still hadn't recovered. The marijuana stock funds? They launched in a frenzy. Some fell more than 90% from the top. The clean energy funds in 2021, down 60, 70, or even 80% after the hype faded. Go back further. In March of 2000, a famous internet fund launched. It raised over $1 billion in days, then lost about 70% in roughly a year. It launched the same month the bubble burst. See the pattern? The fund shows up after the big run, the crowd shows up after the fund, and the crowd usually arrives near the top. This DRAM ETF checks every box on that list. A red-hot theme, a launch after a huge run-up, a straight-up chart, record money flooding in. Now, that does not guarantee a crash. It might keep climbing for a while, but the biggest risk isn't even the timing here. The biggest one is hiding inside what this fund actually owns.
3 stocks wearing a trench coat. When you hear the word fund, what do you picture? Usually safety. Lots of companies, spread out. If one drops, the others hold you up. That's the whole point of a fund. Don't put all your eggs in one basket. So let's open this basket and actually look. About 3/4 of this entire DRAM ETF sits in just 3 stocks. SK Hynix, around 26%, Micron, around 25%, Samsung, around 23%. Together, roughly 75% in 3 names. Let that sink in. You think you're buying a basket. You're mostly buying 3 stocks. And here's the part that's easy to miss. Those 3 all do the same thing. They all make memory chips. They're not 3 different baskets. They're 3 slices of the very same business. So when memory does well, all 3 soar together. And when memory struggles, all 3 fall together. There's nothing to cushion the blow. I call this 3 stocks wearing a trench coat. It looks like a fund standing there, but underneath it's just a few companies stacked on top of each other. Now compare it to a regular chip fund. Let me lay it side by side. The DRAM ETF holds around 14 to 19 names, with 75% crammed into its top 3, all in memory. A broad chip fund holds around 30 names, with no single name dominating, spread across the whole industry. One is a concentrated bet, the other is a real basket. There's one more layer. To hold the 2 Korean companies, this fund uses something called swaps, side agreements with a bank, because regular investors can't easily buy Korean shares directly. In normal times, that works fine, but it adds hidden risk. If markets get stressed, those agreements can behave in ways you didn't expect. So before we go on, I want to hear from you. Quick gut check. Drop a comment right now. Are you holding any single position bigger than 5% of your whole portfolio? Just yes or no. No judgment. I read every single comment, and I'm curious where everybody stands. Because that concentration matters far more for you than it would for a 30-year-old, even if these companies do great. Let me show you why. Why this is riskier in retirement. Here's a fact the excitement makes people forget. Memory chips are one of the most up and down businesses in all of technology. It goes in cycles. Prices boom, the companies build new factories. 2 years later, all that supply floods in. Prices crash, profits vanish. Then it slowly starts over. This isn't a maybe, it's the history. Look back to 2023. Just 3 years ago, Micron's yearly sales fell by about half. Half. The company went from big profits to losing billions in a single year. Memory prices fell more than 50% from their high. The same companies in this fund, the same business. The AI boom has hidden this cycle for now, but hidden is not gone. It's just delayed. So why does this matter more near retirement? Here's the piece most people miss. Let me introduce Ed and Carol. They're 66, recently retired, with a $600,000 nest egg. They live partly off what it pays them. Say Ed gets excited and puts a small slice into a fund like this, around 5%, $30,000. Then a memory cycle turns and it drops 50%. Ed loses $15,000. That hurts, but it's only about 2.5% of everything they have. They can ride it out. They sleep fine. Now picture a different choice. Ed gets carried away and puts in 20%, $120,000. Same 50% drop.
Now he's lost $60,000. That's 10% of their entire life savings, gone in one cycle. And here's the cruel part for retirees. When you're living off your money, a big loss early is far harder to recover from. You're pulling money out while it's down, selling low just to pay the bills. The losses lock in. The money may never fully bounce back. Experts call the years around retirement the fragile decade. A bad hit in that window can follow you for life. A 30-year-old can shrug off a crash. They've got decades and a paycheck. Ed and Carol don't have either. That's the real difference. So does this mean never touch a fund like this? No, not at all. There's a smarter way, and it's the move a prepared retiree makes without flinching. The smart money move. Here's how a calm, prepared retiree thinks about the DRAM ETF. First, they split their money into two jobs. There's the core, the money that pays the bills and has to be safe, and there's the satellite, a small slice set aside for higher risk bets. A fund like this belongs in the satellite, never the core, and the satellite stays small. A common rule is 3 to 5% of everything, at most. On a $600,000 portfolio, that's $18,000 to $30,000. If it doubles, wonderful. If it falls hard, it stings, but it can't sink the ship. That's the key. Right size it. Don't avoid it out of fear. Don't overbet it out of greed. Size it so you can be wrong and still be fine. Second, remember what this fund does not do. It pays you nothing. No dividend, no income. For someone living off their savings, that's a real drawback. It can't help pay your bills while you wait. You only get paid if you sell, and selling after a drop is exactly the trap we just discussed. Third, if you simply want a piece of the AI chip story, you have a calmer option. A broad chip fund gives you memory and the rest of the industry. More baskets, lower single bet risk, and often a lower fee than this fund's 0.65%. So let me leave you with the one line I want you to remember. A fund that doubles in 2 months can't pay your bills, but it can absolutely wreck the part of your money that does. That's the whole lesson. Excitement and safety are two different things. A smart, prepared retiree knows the difference and acts on it. DRAM might keep running. It might cool off hard. Nobody knows. But you don't have to guess to make a good decision. Just size it right, protect your income, and never let a hot story push you off your plan. That's not missing out. That's the discipline that keeps you in the game for the long haul. If someone you know is getting tempted by this fund, share this video with them right now. It could save them from a costly mistake. And tell me in the comments, would you ever put a small slice into a fund like this, or is it a hard pass for you? I really want to know. If you're building retirement income and want to stay ahead of shiny new funds like this one, subscribe to Dividend Hustle. I break down what protects your income every single week. And next time, I'll show you the other side of this coin, a fund that actually pays you every single month, and how it fits into a calm retirement plan. Until then, take care of yourself, and I'll see you in the next one.